Welcome back to the deep dive. Today, we're going to crack open something that seems simple on the surface, but it actually has some surprising, depth. We're diving into how we handle percentages, specifically interest rates,
Great.
especially when we're dealing with different time frames, annualizing, prorating, that sort of thing.
Exactly. You might think it's just one obvious calculation.
Yeah, exactly. But we looked into this expert article, and it turns out there's this really fascinating dilemma. Is the technically correct answer always the right one to use?
That's the core issue.
And you might be surprised, especially, say, in high-stakes financial exams, sometimes the simpler way actually gets picked over the, mathematically perfect one, understanding why. Well, that could be a game changer for you.
It really could. Yeah, this isn't just about crunching a number. It's about understanding the finance behind it and maybe more importantly, the practical side. The article, it highlights areas like money market stuff, short-term lending, basically you're hedging foreign currency risk, interest rate risk.
Right.
You often have to either scale up a short-term rate to a year or scale down an annual rate for a shorter period. And, the method you choose really does change the final number.
Okay, so our mission today is pretty clear then. We need to untangle these methods.
Yep.
Show you exactly how they work, maybe with some real examples from the source.
Definitely got examples.
And really reveal why picking one method over the other matters, especially, like you said, if you're navigating exams or making real financial calls. We're going to explore this tension between precision and practicality.
That's a good way to put it. Precision versus practicality.
All right, let's unpack this.
Right. So the article lays out two main ways of doing this. Let's call the first one method one.
Okay.
Think of this one as operating on a simple interest basis. It's linear.
Linear, simple interest. Okay.
Yeah. You just multiply the percentage by a fraction. That fraction just represents the time period you're adjusting for. Days in the period over days in the year or months over months.
That sounds pretty intuitive, like the first thing you'd probably think of doing.
It often is.
Can you walk us through one of the examples from the article?
Sure. Let's take this sale and repurchase agreement scenario. A repo, basically.
Okay, a repo, short-term loan, right, with collateral.
Exactly. So this company, they sell $10 million worth of treasury bills. That's government debt, short-term stuff. They sell them for $9.6 million.
Okay.
And they agreed to buy them back 50 days later for $9.65 million.
Ah, okay. So they pay a bit more to get them back. That difference is the interest, effectively.
Precisely. So the question is, what's the implied annual interest rate here?
Right. Okay, so with method one, this linear way, how do we figure that out?
Okay. First step, find the increase. 9.65 million minus 9.6 million. That's 0.05 million.
$50,000. Right.
Then what's that as a percentage of what they started with, the 9.6 million? So 0.05 divided by 9.6, that comes out to 0.52%.
Okay. 0.52%, but that's just for the 50 days, right?
Exactly. That's the 50-day rate. Now, method one to annualize, you just scale it up linearly.
Oh, just multiply.
Yep. Multiply that 0.52% by the ratio of days in the year to the period. So assuming a 365-day year, it's 0.52% times 365 over 50.
Okay. 365 divided by 50 times 0.52%.
And that gives you 3.80%. That's your implicit annual rate using method one.
3.80%. Okay. Yeah. Very direct.
Yeah.
And you said if you were going the other way, like prorating an annual rate down, say for 3 months?
Same idea. Just multiply the annual rate by 3 over 12. Simple fraction.
Makes sense. It's definitely straightforward, linear. But hang on. Doesn't money usually earn money? Like interest, earning interest.
Now you're getting to it. That's exactly where method two comes in.
Okay.
Method two fully embraces compounding, the idea that interest earns its own interest over time.
Right. The snowball effect.
Exactly. So instead of just multiplying linearly, you use powers. You raise the percentage figure, 1 plus the rate, to the power of that same fraction, that time period fraction.
Oh, okay. Powers. Right. So back to that repo example. The 50-day rate was 0.52%. How does method two annualize that?
Okay, so for method two, you'd calculate like this. Take 1 plus 0.000052. That's 1 plus the rate as a decimal. Right. And raise that whole thing to the power of 365.50. Then subtract 1 at the end to get back to the percentage rate.
Okay, so 1.0052 to the power of 365 divided by 50.
Minus 1.
And that gives you 3.86%.
Huh. Okay, so method 1 was 3.80%, method 2 was 3.86%.
Yep.
Why the difference?
Yeah.
And is 0.06% really that big a deal?
Well, the difference is the compounding. Method 2 captures that growth on growth. And yeah, 0.06% might look tiny.
Seems small.
But think about it on, multi-million-dollar treasury operations or huge financial contracts running over time. Even tiny percentage differences can stack up to thousands, maybe millions.
Okay, fair point. Precision matters at scale. It really does. And generally speaking, that's why method 2 is often considered the technically correct way to annualize interest rates. It reflects the financial reality of compounding.
Right. Okay. Well, we also had an example of going the other way, right? Prorating an annual rate down, the Marigold case.
Yeah, that's from another examiner's report. It involved a borrowing rate. So using method 1, if you have a 4% annual borrowing rate and you want the rate for just 3 months.
You just multiply by 312?
Exactly. 4% times 312 gives you 1%. Simple.
And that 1% is then used in the next step of the calculation, like figuring out how much to borrow.
Precisely. The example showed borrowing, say, MS 300,000. Using that 1% rate, you divide the target amount by 1.01.
Okay, so 300,000 divided by 1.01.
Gives you MS 297,030. That's the amount you'd actually borrow up front. And that MS figure feeds into the rest of the problem.
Got it. And method 2, for that same 4% annual rate, prorated for 3 months.
Okay, method 2 again uses powers. So it'd be 1 plus 0.04
0.04.
raised to the power of 312 and then subtract 1.
Right, to the power of a quarter, minus 1.
That comes out to 0.99%, slightly less than the 1% for method 1.
Okay, 0.99%. So the amount to borrow would be slightly different too.
Yep. You divide the MS 300,000 by 1 plus 0.00099, so by 1.0099.
Which gets
MS 297,059.
So about MS-29 more borrowed upfront compared to method 1. Again, seems small, but multiply that by larger sums or more transactions.
Exactly. It adds up.
So this brings us to the crunch, right? If method 2 is technically more accurate because of compounding, which one should you actually use, especially like in an exam where you think precision is everything?
And this is where that practical advice from the examining team is so crucial. It's quite specific.
Okay.
For most things in the financial management syllabus, they say, yes, use method 2, because strictly speaking, it is the correct way to handle interest rates when compounding is involved.
Okay, so default to method 2 generally.
But, and this is the big, but there's a major exception.
Which is?
Risk management calculation.
Risk management, okay.
The article and the examiners are very clear. All questions involving risk management calculations in the financial management exam, they will be assessed using method 1.
Method 1, the simpler linear one, even though method 2 is more correct.
Yes. And the reason they give is purely pragmatic.
Which is?
Method 1 is just simpler and faster to calculate in an exam situation.
Wow. Okay. So it's an efficiency choice, overriding pure technical accuracy in that specific context.
Absolutely. For anyone studying for these exams like ACCA, knowing that distinction, well, it's vital. It could literally be the difference between getting the required marks on a risk management question or not.
That's a really critical piece of practical advice then.
Huge.
Okay, so let's try and wrap this up for you. We've basically untangled 2 ways to handle these percentage adjustments over time. Method 1, think linear, simple multiplication.
Quick and easy.
Method 2, think compounding, using powers, more technically accurate, usually.
Reflects financial reality better, in theory.
And we saw those slight but real differences in the results, right? 3.80% versus 3.86% annualizing that repo rate.
Or 1% versus 0.99% when prorating that borrowing rate. Small shifts, but they change the final numbers.
But the absolute key takeaway, especially for exam takers,
is that examiner advice. Method 2 is generally the go-to unless it's a risk management calculation.
Right. For all risk management calculations in that FM exam, you specifically use method 1.
Yep, because it's simpler, it's faster, and that's what they've decided to use for assessment in that high-pressure, timed environment. It's about practicality winning out.
It really shows how sometimes the technically perfect answer isn't the one that gets used everywhere, especially when things like time pressure or simplicity become major factors. It makes you think, doesn't it? Where else might you see this happen? Situations where a more straightforward or approximate method is deliberately chosen over a perfectly precise one. What are the trade-offs there? What really stands out to you from our chat today? Something to ponder.